I'd still keep them open for now, even if you don't use them. It's retail. They'll be out of business in 5 years anyway. Let them close it when they go out of business. Every retailer fails eventually. All right. Yeah, no. I can remember when, even in as late as the late 90s, credit scoring systems were a mystery, and even people in the business couldn't give you accurate information. All right, so most of us are here, right? Well, we'll see if the ladies come back in just a minute. But one of the things I did want to do here is just, when we start back, I just want to use this one more time, and then we'll move on to the other options. Yeah, we'll touch on credit here basically, but if I were teaching a real estate finance class at this level, we'd spend at least an entire class period on nothing but credit and credit scores and credit scoring systems. I pull my credit at least I pull it, at least 3 times a year.
And they say too, like if you keep on checking it like every month or so, or every 2 months, that if it's your credit.
Not true.
Not true?
As long as you're checking your own credit, it's not the same thing as a credit inquiry from a creditor.
Mm-hmm.
So if you come to my store and I look you up at the credit bureau to see if you're credit worthy to buy a stereo amplifier on credit, that's a credit inquiry.
Okay.
If you check your own, or if your existing creditors check just to see what you're doing on other things, those do not count as credit inquiries and do not ding your score.
Thank you.
So how do you do that? To get your score?
Well, to get your score is different.
Oh.
If you go to Credit Karma, it's free, and from what people tell me, I've never gone to Credit Karma, but
It shows you like a list of
yeah,
all the credit cards.
yeah,
you have.
they show you, you get the credit report, but they also give you a score. If you go to annualcreditreport.com, which is the federally mandated site, and it's on the slides here in a little bit, you can get your credit report 3 times a year, but there's no score because they're not required to give it to you. Then I signed up with Quizzle, and I don't necessarily recommend this, but Quizzle is an affiliate of Quicken Loans, and they just kill me with emails every 3 days about how I need to refinance my house, and I'm like, whatever. But every 90 days, they give me a free credit report and with a score. So I like it for that reason alone. The other thing is, if you are lucky enough to have been involved in a data breach with Home Depot or Target or whatever, they will offer you credit monitoring for a year to make up for their lack of security on their sites. Take advantage of that, and for a year you'll get free credit scores. They're free for you, they're not free for the merchant, but they're free for you.
Could you repeat that? I had my credit card compromised by Home Depot probably about a month and a half ago.
Yeah, you talk to Home Depot, and they should be offering, that's the normal fare, free credit monitoring service, which monitors things like identity theft, so that you can be assured that within the next 12 months, nobody's going to appropriate your identity and steal your account and start charging stuff to it. So under the guise of that credit breach, you should be able to ask for that and get it, in which case then for a year you'll get that, whether it's from Equifax or Experian or TransUnion, whoever they're using. Target did the same thing.
Yeah, we got ours compromised at Target.
It's kind of hard to believe that everybody in the room hasn't been breached by one thing or another. We just might not know it.
That's what happened to me too.
It's like an annual event.
Yeah.
There's Christmas, there's New Year's, and then there's the security breach.
I didn't know they were offering that free Christmas off, but I don't think they put that in the letter.
Well, if they did, they probably put it in small print.
They must have.
Or they might have put it in press releases to get the goodwill, and then they don't really want you to take them up on it because it's going to cost them $100.
Yeah, okay.
It's like $8 a month if you go to one of these credit services. All right, the one thing I wanted to point out here, just on this, the worst question that I've ever seen written in terms of math complexity for the state exam in finance took this equation, either one of these, and went one step further. It's in the candidate handbook that AMP puts out, but I just wanted to give you a sense. And again, for me, you're going to have to go this far to give me one of these things, right? The final loan balance, the principal per month, or the interest per month. One of these 3 things will be what I'm looking for. But the question that's in the sample handbook And I like the question. It makes good comprehensive sense. It would just be, it's really challenging for at least half the people who go to take the exam. Is they give you the same scenario with a loan, opening loan amount, and a contract interest rate, and a given payment. And then they tell you there's a prepayment penalty. And they give you that as well. So they make you calculate all of this to get to that closing loan balance for the month, and then they ask you either what is the prepayment penalty amount, meaning you got to take that 1 or 2 or 3 or 4%, whatever the prepayment amount is, and multiply it times the loan balance to get the prepayment penalty. Or they ask you for the entire payoff, including the prepayment penalty, which means this plus the prepayment penalty, right? But either way, in other words, this may seem complicated, but for test question purposes, you technically could take it one step further, incorporating the prepayment penalty stuff we talked about in the last class. Maybe all I'm really telling you is when you see a really nasty, bad math problem, remember, there's always one more step. It could be worse. And I know it's hard, but you know, math, when it has an application and it makes sense and it has a purpose, is easier to understand and learn. Once you can do this in your sleep, even if you don't know the formula. I do not know the algebraic formula to calculate mortgages. I have no idea. I've taught real estate finance at the upper division level at a university, and I cannot tell you what the formula is. I don't know and I don't care because I have a financial calculator and I can do that. And if I have to do that for 360 times, I can tell you what the entire loan amortization schedule is. Right? But, you know, it just, once you get comfortable with it, you can do it all the time. And you can do it in black and blue and red, whatever.
You won't get any further than that. Do we need a financial calculator for the test?
They specifically permit you to use a financial calculator. On the appraiser's exam, they specifically recommend it, and on none of my 5 exam attempts has it ever been of any value. The most important thing to you in there is a percentage key. That's, you know, so if anybody uses a calculator that's like a scientific notation type calculator, like you would use in a science or engineering course, sometimes those don't have percentage keys, and I don't recommend that. Because it's really nice to just go percentage and then know that it's just converted your percentage to the decimal you need it to be. So yeah, I wouldn't, if you have a financial calculator, take it. That's what I do. But I almost guarantee you that in a broker's exam, you'll never use it. Because you're better off doing it manually, the way I just showed you, than putting the calculator, because you then got to dig into that to see the first month's payment anyway. All right, so we know, right, that dropping the term from 30 years to 15 significantly dropped our payment and our interest expense. And we talked briefly about the idea that if you can lower your clients, your borrowers, your buyers' interest expense, you're doing them a much bigger favor than if you're a great negotiator and save them $1,500 to $2,500 on the purchase price, right? There's a lot more dollars at stake in the finance deal. So what are some other ways we can drop the interest rate? One is to go to an ARM. So why do banks give us lower rates on an ARM? Yeah, it's the same thing we talked about before. It's a shorter term. The term in which they are locked in is for a lower period of time. Most, meaning more than half of all the mortgages you're going to see, are that self-amortizing fixed rate level payment loan of 30 years. You're seeing more 15-year loans today as well, but ARMs have been as high as 40% or more at times. Particularly, I think like a 5-year, or what's more commonly referred to today, more accurately referred to as a 5-1 ARM, is really common. 3-1 as well. So there are pros and cons, but I have really never liked anything but an ARM. I rarely for my house ever have had a fixed rate loan. So except when I was much younger, and somebody told me that was a good idea, and now I completely disagree. So the way an adjustable rate mortgage works is that there's some kind of an index to which the bank looks to see what the base is for what the rate should be. Most common ones would be the US Treasuries, bills or notes, depending upon how long it is. Cost of funds index, LIBOR, which is the London Interbank Offered Rate. Those are probably the most common ones. LIBOR is a concoction of the British Bankers Association. It has to do with, banking rates as determined by major banks in London. Became popular in the States maybe 20 years ago. So you take that index, it is what it is on a given date, and you add to it a margin. This is particularly important when you're going to look at what the adjustment is going to be in the future. So it'll be already agreed to what the future rate is going to be, even though we don't know what the future rate is going to be. And we do this by setting a date, and it'll say something in the loan documents. It'll say something like, whatever the interest rate is on the last Monday of the month, on the month before the loan term, is set to, the loan is set to adjust, whatever the rate is that's published in the Wall Street Journal, blah blah blah. That's going to be for the the U.S. Treasuries or LIBOR, whatever. That's going to be the index. And then the margin will be set 1 3/4, 1 1/4, 2 3/4, whatever the margin needs to be for that lender on top of whatever the index is at the time, and that automatically, when that occurs, sets the rate for the next period. So in the case of a 5-1 ARM, for 5 years you have a fixed rate, self-amortizing level payment loan, and then it adjusts every year after that. So at the end of that 5th year, you're going to get whatever you get based upon the margin that is very specific in the note, and whatever the index happens to be based upon the criteria that are also in the note. Those two added together give you your new rate. If you don't like what it adjusts to, what can you do? Refinance. Right? I mean, Now, one thing you should know about, I think it's First American Bank that advertises, it says, and they're not the only ones, that say, nothing but low rates. We don't have teaser rates. That is crap. Every bank that does every lender that does an ARM is a teaser rate. The opening interest rate is not the same as what the index and the margin would be on that date. It's lower. Every one. So if the interest rates don't change, if the index is exactly the same on the date of adjustment as it was on the date of origination, the interest rate is going to go up. So they just refinance. And it's like we talked about earlier, if you're going through a mortgage broker who covers your closing costs, let them pay the closing costs and refinance and keep the rate the same. One of the problems with refinancing every 3 years or every 5 years is, what will you never do? You'll never pay the thing off. You'll always be at that front end of that loan where you're paying off 1% a year, and you can just keep adding that out, adding that out, adding that out, putting that out farther at a time. One of the reasons why 15 and even 10-year fixed rate loans became popular, because people realized, oh, if I do refinance, but refinance into a 15, I've now just carved 17 years or 12 years or whatever, not 17, but 12 years, whatever, off my loan schedule. Now, since lenders are taking less risk and sharing some of that benefit with the borrower to give us a slightly lower interest rate, and I think right now, a 5-1 ARM is like 3%, a 15-year fix is like 3 3/8, 30-year fix is 3 3/4, whatever, roughly. I mean, this is really approximate. But I'd also like to know that if I do take this ARM and interest rates skyrocket, that there's a limit to my risk as a borrower. As I mentioned to you before, I've had personal mortgage loans, in the teens. 13.5 was my highest, I think. I remember when a coworker in 1979, bought a house in Naperville. Small house right near North Central College. Might have been torn down for dorms since then, but I said, the economy was terrible for housing at the time. And I said, Norm, why in the world did you buy a house? And he goes, I got a great interest rate. I'm only paying 16%. Seriously, market was 18. But the seller, who had their house paid off, loaned them the money to buy the house that they were buying from them at 16%. Wow. today, you can't get anything for your money. So I want to know that if rates go to 16%, that I'm not going to be sucking wind. You know, I don't want to be underwater. I don't want to be drowning because of that. So we put caps on the arm to protect the consumer. Because here we're talking about residential loans. So these caps will sometimes sound like a 2.6 or a 2.5. So let's stick with like a 2.6. That's what I think I have, and it's fairly common. The first number in that cap is the maximum amount the rate can go up or down, but we're really worried about it going up in any one adjustment period. So in our 5-1 arm, fixed for 5 years, or let's say we're at our 3 3/4 rate, at the end of that year when it's going to adjust for year 6, no matter how high interest rates have gone, it cannot go higher than 5 3/4 if you have a 2% cap. Right, so 3 3/4, then it could go up 2% to 5 3/4. And the second number, the 6, so a 2.6 cap, means that over the life of the loan, it can never go up or down more than 6%. So right now, I have an arm on my house, a 5-1 arm. It's at 3 1/8. But I think it adjusts December 1st thereabouts of this year. The worst thing that can happen to me is 9 1/8. It can't get any worse than that. No matter what happens with interest rates, I don't have anything worse than 9 1/8. And right today, I could probably refinance it for the same amount, or maybe even a little less.
You said that the 6 was over the life of the loan.
Yeah, first number, so it's a 2-number cap. It would be like 2 and then a slash and then 6. So the first number is per adjustment period, and the second number is the entire life of the loan. So our 3 3/4 deal can never be worse than 9 3/4. 2.6 and 2.5 are the most common caps that I've seen. But if you're going to go for an arm, that's part of what you're looking for. What's the ultimate protection,
When you
Steve?
say 5 and 1, is the 5-year amortization based on a 30-year period then?
Yes, most arms are a 30-year AM loan. You could try and negotiate something different, but I've never seen a lender offer an arm except on a 30-year AM basis. And you lose some of the benefit, right? Once you go to a 15-year, you're picking up half the interest rate spread anyway. So I'm not quite sure you want to take that risk anymore at that point in time, but maybe. All right, so that's the idea of caps. So this is, ARMs were created out of the last financial crisis, or the one that I'm talking about constantly in here, in the late 70s, early 80s, where, banks were willing to make more loans, but they also wanted to limit that long-term interest rate risk. So ARMs were something that were suggested. Any other questions about those? Yeah, just really quickly, I was going to mention the only, under multifamily, it's the only kind of investment property where you can get long-term fixed-rate loans. I've seen multifamily apartment fixed-rate loans as long as 40 years. Otherwise, for commercial investment property, we're typically talking about balloons. At the same time, ARMs became popular, 1981, 82, 83. Balloons were also in vogue. Balloon loan's a little different. So like a 515 balloon, for example, means you have a 5-year term. At the end of the 5th year, what's due and payable in full? Entire loan balance. And it's amortized over a 15-year period. So a 530 would be 5-year term on a 30-year amortization schedule. So the same payment schedules we were just looking at when we were running the math a little bit earlier. And again, in the commercial and industrial space, balloons are the norm. Other than in apartments where you can get fixed rate loans, balloons are what I'm used to functioning under all the time. 3 and 5 years are especially common, 7s also. So how comfortable would you be with a balloon loan compared to an ARM? Which sounds better? If they both get you the same reduced interest rate and the same amortization period, would you rather have a 5-year balloon or a 5-year ARM?
It depends on how much money I have, because you have to pay off that balloon at the end of the 5 years.
Well, how do you pay off a balloon loan? How do you pay off a balloon? Or refinance it. Same way you might pay off the ARM if you don't like the rate. I would argue with an ARM, even if the rate goes down and you like it, you should still refinance it because you get an even lower rate in that first 5-year period of somebody else's ARM.
So then essentially they're both the same?
Not at all. Because if you can't sell and you can't refinance and interest rates have gone to 16% under this scenario, what happens?
You're paying 16%.
Your interest rate has gone crazy high and maybe you can't qualify. So balloons are a little scary for residential borrowers. I know people who had balloons in the 80s, but they're not at all common for residential. ARMs are much more attractive, much more balanced. And the market has gotten accustomed to that. But again, in commercial and industrial space, balloons are what you're oftentimes going to see. So I have to refinance my office building every 3 to 5 years. And it's not cheap. There's a lot of money at stake there. Personal guarantees, fees to the lenders, appraisal costs in the thousands. I think the appraisal is typically about $6 grand every time we have it appraised. Have to pay the legal expenses for the lender and for us, $5,000 to $10,000 a crack. It's expensive to refinance that kind of
Don't
property.
you find it scary, digging a balloon on how, that the rates could just skyrocket? Don't you care?
It's a little risky, okay. So, that's me. We had on this building for a while a floating prime rate loan. So my dad was in charge and alive and well, and we've held this asset since '93, and the current partnership, the general partner had it for 4 years before that. So I think the current partnership had a floating prime rate loan, and it was at one point in time at 9.75%. And I watched that thing float all the way down into the 4s. In which case, at which point in time, no, all the way into the low 5s. At which point in time, the bank said, we're not, when it came to the next renewal, we're not going to do a floating prime rate loan anymore. We paid more ever since. So when I see interest rates in the 5s or whatever, I'm kind of happy. Yeah, I mean, if I think about it long enough, that building terrifies me.
I find that too scary to even go that route.
So, I mean, I'm personally guaranteeing enough debt that it would wipe me out 6 times over. What are you gonna do?
You only live once.
What? What do you mean you only live once? I think that's just a rumor. So yeah, so it's, I would not do that at all if I didn't feel really confident with the asset. I like the property because it's simple. Some of the tenants do not make the lender and the appraisers happy, namely the state. But I work with them on a regular basis, and I don't care if they are 2 months late, 3 months late, because they've been 2 or 3 months late for 23 years. And at that point in time, that's not very late. And I like they're easy to manage. They have professional property managers that work for the state. The people who work in the offices for the state can't call me and say they have a roof leak. They have to go through their property management people who call me. So I'm never dealing with sort of a panicked tenant. They're very easy to deal with. And actually, when I walk in, they have so many problems being state employees that they're just thrilled that I'm going to take care of their problem. They're very easy to work with. I love them as a tenant. If they ever do, I'll be sorry to see them go. But banks and appraisers don't think that way. It's all risk analysis and pure straight dollars and rumor and what they read in the paper. So I don't know. We'll see. Ask me in 5 years or after I'm dead or whatever. We'll see what happens. One problem I do have with that building is it's only a single-story building, so if things get really bad and I jump off the roof, I'll probably just twist my ankle. I said, next time invest in a high-rise. But it is what we're talking about here. It is a little bit scary because there is no limit to that upside. So that kind of problem. I have to refinance it again in a couple of years. If I thought that we were in a rapid interest rate rising environment at that point in time, I might consider anything from selling the asset to doing something different from the financing standpoint. Just because it would feel a lot more unsecure in that regard. But you know, everything that, since I've been managing that asset and been managing real property assets since like 9/11 and thereabouts, has been, you know, steadily declining rates. And I've read the pundits talking for 6 years now about how interest rates are gonna be increasing, and they haven't. We're at 5 3/4 on that asset, I think currently, and I could get a loan at a, maybe even at the same bank for 5 1/4 today. I could still drop it. And if I wanted to and really pushed it, I maybe could get it even a little bit better, and refinance it early if I thought, and then I would have 5 years to deal with it. And we have plenty of equity, so I can take cash out. Again, so there's a lot of reasons why I'm comfortable, though I'm not, I don't sleep 8 hours, I only sleep 6. But that's better than only sleeping 4. So, you know, it's somewhere in there, it's reasonable. All right, so I think I talked about that pretty well. The amortization periods for balloons vary significantly, with banks typically matching the amortization to the kind of free cash flow you have. So if the property cash flows really well, they might be more comfortable letting you have a longer amortization. But really, banks are more common, happier having 20 and 25-year AMs than they are 30, and they would rather have 15 or 20 if possible, even though you're still on a 3 or 5 or 7-year term. All right, things I'm not going to test you on, and I don't think they really matter that much. Growing equity mortgage is really very uncommon today. Read about it in the book. A reverse mortgage, you're probably never going to see as a real estate agent, but it's good to know for life, particularly for those of us who are older. The idea is once you get to a point where you have no debt on your house, you can then go to a lender that does reverse mortgages, and there are quite a few. The idea being basically you borrow money in such a way that you're paid an annuity for 10 or 20 years or whatever. So it supplements your retirement income. And then at the end of that 20-year period, of course, you have a bunch of debt and not any equity, but you're trying to time that so that it ends around the same time your life does, so that you have some extra cash flow. The idea being that, well, that's not true. It's about right. It's a big guessing game.
But in this day and age, you can't really.
No, I
You
intend.
can't count on it.
No,
because you keep living.
I intend to live forever, or at least until tomorrow. But because it's easier to plan that, because it's hard, it's hard to know, when you go, it's really funny, right? Because when you, up to a point at least anyway, the older you get, the longer your life expectancy becomes. So the average might be 73 and 77, but once you're 70, it's like 82 and 85 or something like that. So I mean, you really do have to plan for the long term. So.
My mom is 94, and she just had a heart valve replaced. So see what I mean?
Yeah, no, I see what you mean exactly. You can't count. No, I agree. I have an uncle who lived to be 102, my dad's brother. And, he worked at the Postal Service for 41 years. He ended up being retired only 1 year shy of the number of years he worked. His son retired from the Postal Service at 55. He's my first cousin, and he's now, what is it now? Is it 87 now? He will easily, I presume, be retired for more years than he worked in that system, which is one of the reasons why retirement plans are failing all over the place. We're just too darn healthy. So anyway, I don't need to worry about that for the state exam if we're here, because it's not really the business of us as brokers, but it's good to know for life. Let's talk about the term recourse and non-recourse. Residential loans are all recourse. In other words, the lender not only has recourse against the property, which they always do because of the lien, but they have recourse against the borrower. If you default on your residential property, whether it's an investment property, a vacation home, or your principal residence, they can come after you. That's the whole idea of the deficiency judgment, right? You owe the debt, that's a recourse loan. So residential loans like that are all recourse. Non-recourse is when you're talking about commercial, industrial, multifamily type property where there's no personal guarantee. So you can bet that when Donald Trump gets together with a bunch of partners and comes up with $150 million or whatever it took in cash to put down to build Trump Tower, in Chicago, he did not put up a personal guarantee. Yet I have to personally guarantee the office building in Aurora because they won't loan us that kind of money. We're not in that class. But once you get to that class, you want to stop doing those personal guarantees. There's no point in forming a corporation or a limited liability company to set up a real estate development, only to have to go right back and sign away your life to guarantee that in the case of a default, you'll step in and take care of the lender. You know, whatever liability avoidance you set up by creating the single purpose entity in the first place, you've now defeated by signing over or taking on that obligation. So non-recourse is the way to go, but it takes a while to get to that point, at least it seems to for me. That's another reason why I don't want to refinance my property currently, is that if I thought I could refinance it without any personal guarantee, I'd be much more interested. It costs the partners money. I will not do a personal guarantee without charging them a fee. Nobody else would. All right, other terms. LTV, or loan to value, good term to know. Basic idea is, you know, if you put down no money, you have a 100% loan to value. If you put down half the money, it's a 50% LTV. If you put down 20%, it's 80% LTV. So I put up here, it's the opposite of your equity or down payment. Higher LTV means lower down payment. Higher LTV means more risk for the lender because there's less equity to draw on in the case of a default. Lower LTV usually means better interest rates, at least to a point. You tend to have lower LTVs required, meaning more down payment required on any kind of investment or non-owner occupied property. Even in commercial space, if you're a business, so if Ken takes his siding business and wants to buy a property for both investment and to run the business, he'll get a lower interest rate and be able to put less money down because he's an owner-occupant business than I would if I bought the same property and rented it to him. I'd have to put down 25% as an investor. He might be able to get away with 10 or 15% down as an owner-occupied business. Because lenders look at that risk, those who do small business real estate lending like that, the same way they do residential, where you're going to occupy it. They'll give you the least amount down and the greatest interest rate because they think the chances of you defaulting are less if you're using the property personally rather than renting it out to somebody else. A conventional loan simply means that there is no government guarantee and no government insurance involved. In other words, it's all private market forces at work. When we go back to 1934, prior to the formation of the FHA, and looking at the Great Depression or the period that followed on its heels, where we had tremendous periods of boom and bust for a long time, right up until the time of World War II, really, that sort of snapped us out of that mess. It was common to put down 50% or pay cash. That was normal. So to get us out of that, the government stepped in and said, we'll do as little as 3% money down through the FHA to create construction jobs, to create more economic activity. That was the whole idea. So that's become part of our fabric. But instead of 50% down, lenders on a conventional basis eventually got comfortable with 20% down. That's kind of the norm. So if you want to go for a conventional loan, no FHA, nothing else fancy, just go to your local bank, 20% down, even as a homeowner occupant, is where they say they'll take on the rest of the risk if your credit score is adequate. But it is not a conventional loan because it's 20% down. It's a conventional loan because it's not FHA or VA or something like that. It has nothing to do with who's in the background. It doesn't matter if Fannie or Freddie or anybody else is buying the loan. That's irrelevant. It has to do with that primary market. So under a conventional loan, if you have less than 20% down, private mortgage insurance is the private market force that steps in to fill the gap to take up the risk.
All right, let's say you do get a loan and Freddie or Fannie end up buying it. It's still conventional even though they're 80% owned,
Correct.
Government owned?
Because they're on the back end. They're there to work as a conduit to get the money from the investor pool to the bank. And all Fannie and Freddie do in the middle is provide the guarantee,
Okay.
right? So that the investors are willing to buy those loans from the bank. So instead of buying them from the bank, they buy them from Fannie, who bought it from the bank. And Fannie strips off the money so it can operate and pay a profit, which it has done for about the last 4 or 5 years. Fannie and Freddie have generated a lot of profits for the U.S. government. Well, the government's ahead now at that point in time. may have seemed crazy to a lot of us at the time, but the government overall has made money on the economic bailout. So that's basically the definition of conventional. PMI is actually a knockoff of the FHA idea of MIP. Mortgage insurance premium is how the FHA funds its life, funds the risk. It's borrower-paid insurance. So the private industry woke up and said, well, if the government can do it, we can do it more efficiently. So PMI, there's about a half a dozen well-known private mortgage insurance companies who took major hits in the economic meltdown, by the way, because a lot of properties defaulted. And what PMI does is it represents the missing equity. So if a bank says, we're comfortable with 20% down, we'll take that risk. Even though in the case of a default, we're gonna lose up to 40% on that property, we're still comfortable because we don't have many defaults compared to the size of our portfolio. And if we have less than 20% down, we'll make the borrower obtain PMI, which covers us for anything less than that 20% that's there. So the more you borrow, the higher your PMI in terms of both dollars and percentage. So if you put down 5%, you'll have PMI that's higher than if you put down 15%, right? Because you have a greater dollar amount to insure. If you're buying a $300,000 house instead of a $200,000 house, you would pay more PMI if you have it because you've got more money. So that's the basic idea. And you can get PMI to drop off once you've got enough equity. You have to refinance, you may have to get an appraisal, especially if you put money into the house and you can't get it done in a matter of months, it could take a few years. But once you can demonstrate that you meet the requirements, PMI can be taken off. It's up to the lender, it's their call. Okay. I threw this in here, this really isn't in the text at all, but we've been talking about it a little bit, so we'll mention it. The better your credit is, the lower your interest rates are going to be, and the more loan options you're going to have. You need a certain credit score to qualify for certain loan types. So if your credit score is low enough, you won't qualify for maybe conventional loans, for example. This is constantly changing. Lenders come up with their comfort zones. As they have fewer defaults, lower credit scores will be more acceptable to them. As the defaults are higher, they'll start to change that. Changed fairly quickly after the economic meltdown. It got a lot better pretty fast in the last few years. So again, what's your role as a broker, as the agent of your borrower client? Again, have your people manage their credit actively. So here's just some real quick things. This is the website, annualcreditreport.com, that's mandated by federal law. I think it's under the Fair Credit Reporting Act, but I'm not sure about that. And those are the three credit agencies, and every year they are obligated by law to give you a copy of your credit score through this website for free. This is not freecreditreport.com, which is a commercial site. Annualcreditreport.com, they're obligated to do it. They are not obligated to give you a score, as I was saying earlier. They're obligated to give you your credit report. So, you have a choice. You can go on a given date every year and pull all three credit reports all at once, or what I recommend you do instead is put it on a 4-month cycle. Put it in a calendar. So let's say, for example, on January 1st, you go to the site, you pull your report for Equifax. On May 1st, you pull your report for Experian. On September 1st, you pull your report for TransUnion. Next January 1st, it's a year, and Equifax owes you another report. The reports are similar, but they're not identical. It depends on what creditors of yours report to what bureaus as to what's going to be in each report. But you're going to get more accurate information spread out over the year if you get 3 reports 4 months apart than if you get all 3 reports on one day of the year. Especially if you're looking for things like, hang on, I don't have a credit card with, Jones department store. Who is that? That's an identity theft problem. So again, that's how that whole idea works. And once you get into those sites, it's very easy to get redirected, and those companies will gladly try and sell you services, but you have no obligation to buy anything from them to get that federally mandated credit report. And then you can see your credit report, which is really boring and dull to read, especially if it's all correct. If you don't like it, you have grounds to object. If you think that it's wrong, there's debt on there that's wrong, you can object and get it cleared off. We don't really have time, or it's not really part of this class to do that. But for example, my wife one time stepped in for one of my lovely adult daughters and worked out a plan on her behalf for her to have reduced debt with a particular bank, who then took it upon themselves to report my wife as the owner of the account, which we had to contact the credit company and say, no, that's not what happened. Here's what happened, and they changed it. You know, her debt's wasn't her, you know, her debt wasn't our debt. Junior and senior, really common. Had a student in here one time who told me that his father had some serious credit problems, and they showed up on his credit report because he was a junior, same name, so he had to go in, you know, he had to write them and point that out. So you want to keep an eye on this, because even innocent things can cause a problem. My name's pretty unique, so I don't seem to have those kinds of problems, but if you have a name that other people share, then it's more likely something's going to get misreported or miscoded. Or you might just have a dispute with a creditor. True, you didn't pay the debt, but because you feel you didn't owe it to them, you can put information in, even if it doesn't get removed from your account. You can put a statement up to 100 characters, I think, or was it 100 words, in your own credit file disputing any charge. All right. So under other loan programs, the FHA, as I mentioned, is a borrower-funded, government-insured loan program. I think the minimum down today is 3.5%. And there's an upfront mortgage insurance premium, or MIP, that's paid at the closing, though what do they typically do with that? Roll it into the loan. And we talked about that. Sounds great, but you're just borrowing more money. So you don't have to come up with the cash, because it would be kind of goofy to have a 3.5% down payment, but have to come up with an additional 2% in MIP at closing. It would preclude a lot of low down payment folks from buying, so they roll it into the loan. And then you pay every month, and you can't get rid of MIP today unless you refinance or pay off that loan. It's there permanently. So it's not like PMI, where I said you could get an appraisal 2, 3, 4, 5 years down the road and show you have equity, or write a check for 20% of your equity. MIP stays for the entire time the loan is in effect, so you have to refinance or sell the property to get rid of it, pay it off in some manner.
MIP apply even if you have an 80% loan to value?
If it's an FHA loan, yes. FHA loans, interest rates are typically higher. Not by a lot, a quarter point, something, but they're typically higher. FHA doesn't make loans. They're made by FHA-approved lenders who look at this and say, there's a lot of extra paperwork, there's extra bureaucracy, and as I mentioned the other night, you have to forbear for a long time. If you want to get the FHA to buy you out of your bad loan, you have to follow all their rules, which can mean working with the borrower for a year or more while you're receiving no payments, or limited payments, or whatever, and then being willing to work all that out with them. The FHA is all about accommodating people. Lenders are all about making money, and the two don't necessarily mix really well. So because of that, there's a higher cost to servicing and working with an FHA loan, and so the lenders charge a higher interest rate. Lower credit scores than conventional is one of the reasons that this is attractive. You can have higher debt ratio, and so you can buy more house with an FHA loan, particularly if you're in a lower income range. So again, it has positives and negatives. You can have points and fees; those are pretty common up front, including plus the MIP. So it's not a cheap loan, but if you can't buy a house any other way, and when the financial crisis hit for about 3 or 4 years, for a lot of us, the FHA was the only game in town. Again, banks couldn't figure out what to do for a while. You can prepay, no prepayment penalties are allowed on FHA loans, so you can prepay anytime that you want for any other manner. And there's a lot of different loan programs. I just put down a couple here. A 203B is the most common, typical FHA loan, fixed rate, whatever. A 203K is that where a construction loan is built in. So if you want to do a remodel, and the 203K and 203B are good for up to 4 units. So on a 203K, for example, you could buy a house or a 4-flat or a 3-unit plus a storefront, which is still a 4-unit, and you not only get the money to buy the place, but you get escrowed money to do construction work along the way, and then the escrow funds pay off the contractors, material suppliers, whatever, and the project's all done, the rest of the money's released, and you've got that loan. So, I mean, again, there are ways in which to do that. The 203B loan's fairly common. All FHA lenders will do that. 203K, not so much. There aren't that many that are expert in that. There's also a 203V, which is for veterans if you're not already using your VA loan or you like this better. But there's lots of 203 loan programs for individual borrowers. They also have 202 loans for large-scale apartments and things. Again, FHA, I mentioned, does not loan money on single-family residential or up to 4 units, but they do. FHA does loan money on large apartment complexes. The biggest one that I've been involved in was a couple hundred units. VA is different than the FHA in that this is a loan guarantee, and it's a partial loan guarantee, and it's an entitlement of military service. There are a lot of VA loans being done today because of the number of people who have gone on active duty or even enough reserve time, whatever it takes to earn eligibility. But FHA loans are still way more common. So to be able to obtain a VA loan, you've got to be able to prove that you're eligible. So you go through your discharge papers and prove that you have the adequate amount of service, depending upon what conflict or peacetime or whatever you want to call it that the vet was involved in. It can take months to go through this process. So the vet has to plan fairly far in advance. You need to have a certificate of reasonable value or a CRV, which is a little bit of extra paperwork to go along with the deal that's beside the appraisal to make sure that it's adequate money. The VA is also taking significant risk in providing this guarantee because it's basically a zero money down deal. It's a partial loan guarantee. So let's say that you're borrowing, or let's say you want to buy a $240,000 home as a vet. You get a 25% loan guarantee, which means that as a vet, you can buy the house with no money down because to the bank, the VA is going to guarantee the first 25% of losses. So the vet borrows $240, and the vet repays $240, but the bank assesses the risk as only being 75% of $240 because the VA is putting up a guarantee that so long as the bank, if the borrower gets into default, follows all of the VA rules, will make them whole up to that 60 grand or whatever the loan guarantee amount was. Now, only a vet can borrow this money, though it is possible for a non-vet to assume a VA loan. But a vet's eligibility is limited to a specific dollar amount that's capped by legislation. And if the vet does not pay off the loan when they sell the property because it's assumed by a non-vet borrower, then that vet's eligibility is tied up in that existing loan until it's paid off. And VA loans are only for, can only be originated if the vet's going to occupy. So a veteran cannot use it for a home for his mom or somebody else. Can't use it for a vacation home or a rental property. Although, remember I said about a statement of occupancy, a vet can buy a house with a VA guarantee, live in it for whatever the occupancy period is required. I think it's 6 months or a year is all. And after that, move out and turn it into a rental property and go get conventional financing for a different property. And you technically can have multiple VA loans, but the total amount that your guarantee is still can't be above the limit, whatever that dollar amount is by law at that point in time. There's discount points and fees have to be reasonable. There's an upfront funding fee here. There's no insurance. It's not an insurance program. It's a one-time funding fee, 2.25% or 2.5% something paid by the vet at closing. It can be paid by the seller. Sometimes you'll have that kind of arrangement. The vet will say, you want $240 for your house? Okay, I'll pay $240, but you pay my funding fee and some of my closing costs and that kind of thing. And the VA has rules. There's sometimes a cost or two that the seller can't pay. But that way, rather than negotiating a lower price, the vet's willing to pay full price, but have the seller pay some of the vet's closing costs instead. And again, no prepayment penalties on VA loans either. I think that's pretty much it. You could go your whole career and never see a VA loan. Quite a few vets, when the market is healthy and conventional lenders are willing to do deals, quite a few vets will borrow conventional money because it's just easier. And if you've already got one home under a VA loan, you have to pay that off, prove your eligibility, prove that that's paid off, to prove your eligibility to do the next one. Very difficult for a vet to sell with a VA loan and buy with a VA loan. So usually once the vet's into the market and has created equity through home ownership, they'll never go back to a VA loan typically. Questions about any of that at all? All right, then there's some of these other programs that, more likely to use if you're west or southwest or maybe a little bit northwest of here, but not something you're going to see around here too much. Purchase money mortgage term. Basically, anytime you create a new loan in conjunction with a sale, it's a purchase money mortgage, just by definition. But the most common use of the term has to do with like the seller taking back a second mortgage as part of a sale. So an example is, you have a seller who wants $300,000 for their home. Let's say they have little to no debt on the property. They've lived in it for a long time. And a buyer comes along and says, I qualify for $300,000. I'm willing to pay $300,000, but I can only get a new $240,000 loan, and I've only got 30 grand in cash. So I'll put down 30 grand in cash, and I'll put up a $240,000 loan, and you, Mr. and Mrs. Seller, you take a note from me, and a second, secured by a second mortgage position on the property for 30 grand, and we'll call it a day. So in that kind of scenario where you have a seller willing to take back a second, as they say, who takes, a second mortgage position where they're now going to get interest payments at an above market interest rate on that note that's secured by a second mortgage, then you can do that deal. It's not at all uncommon. Sometimes you have a borrower who's willing to purchase. They can afford to purchase based upon income, but they don't have all their cash that they need because some of it's still tied up in a previous property, and they're willing to sign like a 12-month, no contingency on the purchase, but we need a second mortgage for 12 months. When we sell our other house, then we'll put the rest of the money down. What's the incentive for them to do it? Charge them 8-9% on the second mortgage. Then there's an incentive for them to get out from underneath it fairly quickly.
Is that used ever to hide purchase price for tax evasion purposes?
Not that I've ever seen it.
When you have to record that second mortgage?
Yeah, you don't have to, but you want to, right? I mean, you want it to be recorded, so it should be. I've seen things misrecorded. When you have odd sales like this, I've seen things get misrecorded because at the closing they're handled wrong. My own house, I bought it, on a land contract, which was for, how the heck can we do that? Oh, I got a $292,000 first mortgage loan, and I took out a second mortgage with my friend who was the seller when I refinanced it out of the land contract a year later for $50-some thousand, and that second mortgage never got recorded. And so it shows in the public record that I paid $292,000 for my house when I paid $350 something. It wasn't done on purpose. I didn't do it. I never changed it. But that was wrong for that reason. So maybe it happens accidentally. I don't know. Anyway, so that's the idea of a purchase money mortgage by definition. Should just be able to recognize that. A package loan is when you're buying the whole package. It's not just real estate, it's personal property too. Builder's model, condo in Florida, people who have second homes and furnish them, when they're done with the second home, they don't need the furniture. So what do you do with it? You sell it with the condo, or you sell it with the vacation home. So it's not at all uncommon to then buy that property, including the personal property. So if a lender makes a loan against, for real estate and personal property, it's called a package loan, that's all. I really had hoped that I had had the cash when the economic downturn hit, because it's really kind of cool to walk into a builder's model with all the really awesome decor they have, and things are really tricked out, it looks lovely. And there were a number of them around here that sold at a fairly good price, totally furnished. Would have been a package loan. But alas, I was caught in the same downturn as everybody else. Blanket loan. Let's think about the typical loan. You borrow money against the property, and when you sell the property, you have to provide clear title, right? Marketable title, which we talked about earlier in the class. So what happens when you only sell a piece of the property, and another piece, and another piece? So think about a home builder in a subdivision. So you go and you buy a 40-acre farm, and you carve it up into 120 residential lots, and you borrow money against the entire 40-acre parcel. You put all the money in here for the improvements, and every time you sell a lot, you're releasing a piece of the collateral that belongs to the lender who loaned you money to buy the farm and to develop it. So now when you sell lot number 1 to your first customer, whether it's a home builder or a buyer, doesn't matter, you've got to provide clear marketable title. So now the asset that's left for your lender is different. Are you going to refinance it at that point? Wouldn't make any sense. Same thing is true if you buy an apartment building and you convert it to condos. You sell those condos off one at a time, releasing your collateral one piece at a time. So what the lenders do, they build in these kinds of situations, an automatic release clause for each piece that you're going to sell off, and then they put a dollar amount in there that says, when you sell this condo, you pay us back 40 grand or 60 grand or 80 grand or whatever. So that by the time you're about 60 or 70% sold out of your development, the loan is paid off. And the lender's happy, and you didn't have to refinance every time you sold a piece. It was just all part of the original deal. Just a partial release clause built into the loan that otherwise blankets an entire property that you have since, by design, carved up into many smaller pieces. Mechanically, it just makes it a lot easier to do. I wouldn't worry about a wrap. They're very rare, so I'm just going to skip that. Open-end loans, I'm just going to skip that. Let's talk about construction loans. Construction loan is temporary, hence the term interim financing. End financing or permanent financing is usually a requirement of being able to do a construction loan. Sometimes it's the same lender, but oftentimes it's different. So what a construction loan is obviously you're buying either vacant land or an existing property that's going to be rehabbed, and the whole idea is that the construction loan is for all the construction activity. Not all lenders do this. Banks with construction lending departments do this, and they'll have a construction inspector and loan officers who are accustomed to dealing with this. So you get a sworn statement from the contractor that's going to do the work, the general contractor or the home builder, that says, I swear these are our breakdown of costs. This is what it's going to cost. X dollars for the earthwork, for the concrete, for the masonry, for the wood framing, for the trim, for the roofing, for the sidewalks, for whatever. It's all broken down line by line. Then every month, the contractor comes to the project owner, the home owner who's having this house built for them, or whomever the developer is or whatever, and says, feed me. Here's my sworn statement with how much work we've put in place this month. The plumbing is now 60% done. The carpentry now is 85% done. And they want to get paid for all those dollar amounts. So the owner of the project then takes that to the bank right away and says, my contractor needs money. Pay him out of the loan that I have. And they work through a title insurance company. Once the bank is comfortable that that work has actually been done, they go out and look at the site and say, yes, we agree that these amounts are in place and we'll fund that. They work with a title insurance company to exchange lien waivers. So the contractors exchange, give a document where they waive their mechanics lien rights in the amount that they're about to be paid, and they exchange that for a check each month. And that's how the process works. And then at the end, when all that's been done and the work is finished, the permanent financing kicks in and pays off the construction lender in full. That's the basic idea of a construction loan. If you want to do that kind of thing and you've never done it before, a bank might want to know what kind of construction experience do you have. So somebody like me who's got a lot of experience, or Ken, or anybody else in the room who's done a fair amount of that, more likely the bank will let you be your own general contractor on a project. Less likely they would for somebody who has little to no experience. You know, the last thing a bank wants is to take back a half-finished project. That is really messy. I've looked at a few of those, and I'm really conservative, and there's no way I will get anywhere near what people eventually pay for them. I swear people overpay for those things. All right, other financing techniques we're talking about here, sale and leaseback. This is an interesting idea. The idea basically is that the existing owner of the property doesn't want it anymore, but they don't want to leave. One of the more obvious and recent examples of this I can give you was SunTrust Bank in 2007 or 2008. When it was clear how bad the financial picture was, SunTrust took a look at their own situation, swallowed hard, and realized they had a serious capital issue. So they packaged together a number of branches and sold them to Inland Real Estate in Oak Brook, or one of their affiliates, and raised, I don't know, $70 million in capital or something by going from being the owner of their own banks to being a tenant in one fell swoop. But it was cash. They converted their real estate into cash, and they've been paying rent to Inland or whomever ever since. That's a sale and a lease back. You sell the property and you lease it back. If you had a situation now, currently, for example, with an investor, let's say you have a manufacturer here locally, and the manufacturer wants to stay in business but doesn't want to own the real estate because maybe what they would rather do is sell the business. The manufacturer could first sell the real estate to a real estate investor, stay there for 3, 4, 5 years and operate, and later sell the business, which maybe stays there for another 20 years. So you have ready-made investments, a proven tenant who's going to be staying there for a long time, who has a lot invested in equipment and other things. It's a real clean deal. General Motors raised $1 billion by selling their headquarters in 1983. Themselves out of bankruptcy then. And they had an option and bought their headquarters back a few years later when they were profitable. A buy down is a temporary interest rate reduction. It works the same way as discount points, but it's spread over the life of the loan for 3 years, 2 years, and it's in a staggered kind of basis. So a buy down is a good tool for a home builder, though really it could be available to anybody. So if you're a home builder, building a subdivision out here, and you're trying to spur sales, you could just, send your painter up to the billboard you have and reduce where it says prices starting at $279.9 and paint through that and change it to $249.9. But it's a little bit like a gas station. If you got 2 gas stations on a corner and one drops their price, what does the other one do? Drops their price. Now, not only do you still now not have any more customers than you had before, but you're now making less money. It's just not a good strategy. So home builders have figured out, well, if we make this price reduction stuff secretive and hard to follow, then we can entice consumers and our competition won't really know what to make of it. So they don't reduce the price. Instead, they offer you an incentive. Rather than drop our price X thousands of dollars, how about if we buy the interest rate down? So instead of 4% fixed rate money now, you can start off, and in the first year you'll have a 2% rate. In the second year you'll have a 3% rate, and in the third year it'll go to 4% and stay fixed for 30 years after that. So they use the cash to buy the rate down for the first couple of years, which does a couple of interesting things. Since what you qualify for is based upon that first 12 to 18 months, you now qualify for more house. And if you buy more house from that builder, they make more money, especially if you buy high-priced options. Costs them 10 grand to build a basement and you buy one for 30, they've made all their money back. But not only does that happen, but now more people qualify for that house because more people can afford it at 2% than they could at 4%. So it opens up a broader market, and they didn't go up and just say, we dropped our price 30 grand. they gave you something else of equal value. And it's easier to stop. This weekend only, you know, only on Sundays, which are, you know, that are odd days during months that, you know, end in X or whatever they do. So it's much easier, you know, trick for them to use. And anybody technically could do it. So if you wanted to sell your house and you're having trouble, you could offer a buy down if you wanted to. You just have to talk to a lender. Builders tend to have relationships with a specific builder, or many of them own their specific lender, or many of them own their own mortgage brokerages or mortgage banking type firms. So in which case they can, you know, optimize these. I'll skip home equity loans, just when you borrow money against the property you already have. Let's see what we got here. Can we get through this? Yep. Okay. My voice should hold out and get to the end of this. All right, last thing we got here is just some regulation stuff. So before we get into that, any other questions regarding any of the loan programs that we talked about at all so far? So the Truth in Lending Act and Regulation Z, you can just assume those are synonymous for purposes of this course. Regulation Z is propagated by the Federal Reserve as a part of the Truth in Lending Act, but basically the same thing for what we're talking about. So, Truth in Lending Act does a number of things. For one, it creates this 3-day right of rescission. So this is a lending issue, and it's for consumer lending, such as the purchase or refinance of real estate. Now, the 3-day right of rescission is limited in real estate application. You cannot use it for a purchase, but you can use it on a refinance or a home equity loan or home equity line of credit. Basically, on a refinance, it would sound like this. Let's assume you're going to go into your lender and you're going to do a cash out refi. So you go to the lender on Monday, you sign all the documents at the refinance closing, and you're expecting your check for $10,000 that you're now going to take to go buy a couple of jet skis or whatever, and they don't give you the money. They say, come back on Thursday. Everything's done, but the money doesn't go anywhere. It just sits for 3 days until your 3-day right to change your mind disappears. That's what a 3-day right of rescission is. Up to 3 days to say, nah, never mind. If on Wednesday you walk into the title company and say, forget the loan, they have to unwind the deal. And the only way they can unwind the deal is if they've never actually sent the money to pay off your credit card debt or your existing mortgage loan or whatever. So that's why you walk away with nothing for 3 days, and after that they disperse. So that's the basic idea. And it's only a finance issue. So if you walk into a home builder on Sunday and say, hey, I want to buy a house, here's my deposit, you can't go back Monday and say, I'm exercising my 3-day right of rescission. There is no such thing for a purchase. It doesn't work on cars either. It's very limited. This was designed to deal with things like an encyclopedia salesperson coming to your house and selling you, you know, buy these encyclopedias financed at 30% over the next 3 years, where you'd be able to sort of slap yourself when you woke up and go, I don't want to do this. I didn't know, whatever. So it's limited. There are certain advertising requirements, especially as it relates to the APR. APR stands for annual percentage rate, and it's not the same as the contract interest rate in most cases, so it's not an interest rate at all, which is interesting because it's supposed to clarify things for consumers, but it's really kind of confusing. The way the APR is calculated is you take all of the expenses related to the loan, meaning all of the contract interest rate as if you held the loan out to its full term, whether it's a car loan or a house loan, doesn't matter, plus any lender fees and costs you paid, like discount points and loan origination fees and other things. And you add all those costs, all that interest, prepaid or full term, whatever, you add it all up and you redivide it out backwards as if it had all been contract interest and say, well, what would that have been as a contract interest rate? And that's the APR. The theory being, if I have loan A and loan B and loan C from 3 different lenders, I could look at the APR and be able to tell which one is cheaper over the full term of the loan. But the calculation is only accurate if you actually hold the loan for the full term. You pay it off in 5 years or refinance in 3, and the APR meant nothing. In fact, it could be misleading. But it's a requirement in ads once you say things like, you know, buy this house for a monthly payment of under $1,000. APR, hello, we want to know what the principal and interest are, the interest rate, and the APR. All that's got to be disclosed in the ad once you use certain trigger words. I think that's probably enough for that. It's just knowing a little about the APR and the 3-day right of rescission is probably the most important thing out of that. Equal Credit Opportunity Act we'll come back to a little bit in Chapter 21. It's really kind of a fair lending law. Suffice it to say that the Equal Credit Opportunity Act is broader in its reach than some of the fair housing laws we're going to talk about, in that the protected classes include things like source of income, so a lender cannot discriminate based upon where your income is coming from. So if the income that a borrower has comes from welfare, for example, or disability payments from the government or whatever, and the lender says, well, that's ridiculous, I don't want to loan to them because this is a welfare queen or whatever they want to say, whatever term they want to use, can't do that. As long as the money's verifiable and it's consistent and it's provable, it's income, and you've got to use it to qualify them for the loan. The source of income is pretty significant. And I say it's pretty broad because equal credit is for anybody who extends credit. And we'll talk about in the next class, what is a lease except for an extension of credit? So that source of income is a pretty powerful thing there. So when we get to fair housing, once we have leasing and fair housing, think about this again and hopefully it'll make sense of the bigger picture. Community Reinvestment Act is an attempt by the feds, it's kind of a voluntary thing, but it's an attempt by the feds to force banks to do what they historically did, which was to loan in their own neighborhoods. Again, this is kind of a fair housing related, fair housing, fair lending issue. But the CRA allows banks basically to come up with a volunteer compliance program, which most of them do because you don't say no to the Fed if you're heavily regulated like banks are. What happened in the 1940s, 1950s, 1960s, the banking industry across the country being dominated by white men, looked at the racial and ethnic makeup, particularly of certain cities in the north, particularly as black population moved from the south to the north. Our lovely white selves looked at that population that we've said for 200 years, oh my God, yes, they should be free, and said, oh my God, but we didn't mean here. And so bankers wouldn't loan money to communities, particularly that were heavily black in population. Well, what happens to the value of a neighborhood if you can't borrow money to refinance or to improve your property and nobody else can borrow any money to buy it? What happens to the value of the neighborhood? It goes straight down and in a hurry. And 20 years after those bankers made those kinds of decisions, they look at these shitty neighborhoods that they helped create and go, they went, yep, look at that. See, we were right. Never should have loaned any money in those neighborhoods. So the CRA was an attempt to say, look, your bank is here. Explain to us why you don't loan any money in the area around your bank. And so, draw a neighborhood, establish your territory, and show us that you're going to loan money within those areas. Again, it's a voluntary compliance thing, but it's a fair burden on a number of banks. And then RESPO we'll talk about in more detail in Chapter 23, but suffice it to say that this legislation is more impactful on real estate financing than any other legislation we're going to see. Maybe with the exception of the creation of the Consumer Financial Protection Bureau, which I really don't know much about yet. But RESPA, the Real Estate Settlement Procedures Act, we'll talk about in a little bit greater detail, but it affects all residential real estate loans, not all, but most residential real estate loans, not the sales, but the loans. Questions about anything from tonight? Well, I understand spring is arriving on Saturday in the form of normal, not above normal temperatures.
I hope so. 'Cause I
But
have
if I'm
two
not
windows
mistaken, and I looked at a forecast today and I dropped my phone, and so I'm not sure, I was afraid to pick it up for fear it had changed. It's actually going to hit 50 next week. No, I do not, but thanks for asking. I'm sure there's probably a minus sign in front of that somewhere. So, chapters 17 and 18 for next week. Those two pretty much go hand in hand. We should get through each chapter each night, I think.